Softer than expected US wholesale inflation data drags down US Treasury yields again. Australia's unemployment rate drops, but a fall in hours worked indicates a softening labour market. Taiwan's central bank holds rates, and the Bank of Japan is expected to hike later today. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior China strategist Zhaopeng Xing explains why additional stimulus should be expected sometime later this year from China.
At this moment, the external demand reflected by the China export to other countries remain very strong. It can buy some time for the policymakers to make the decision.
But first, in 5 and 5 with ANZ, US wholesale prices fell unexpectedly in May. That drove US Treasury yields down about 4 to 5 basis points, and US stocks are up about 0.3% by 5 a.m. Sydney-Melbourne time. The Aussie dollar down 0.4% at 66.34 US cents, and the Kiwi down 0.3% at 61.70 US cents. Here's ANZ Head of G3 Economics, Brian Martin, on that surprise US PPI fall.
The impact of the data on markets was to reinforce expectations that the Fed will be cutting interest rates this year. The market is now almost fully priced for 2 25 basis point rate cuts. It is 75% priced for a 25 basis point rate cut in September and over 100% priced for a 25 basis point rate cut in November. The inflation data have worked to, in some way, override the dot plot that the FOMC published with its June policy meeting.
Number 2, Australia's unemployment rate fell from 4.1 to 4% in May because jobs growth of 39,700 outpaced expectations. However, ANZ senior economist Blair Chapman says below the headline figures, there was a 0.5% fall in hours worked, which indicates the labour market is loosening.
If you think about hours worked being the reason why you would bring more workers on, so if you're at capacity, you've got your current workers all working full-time and even doing overtime, you're going to bring on more workers, and that's indicative of a really tight labour market. And when the labour market's loosening, you do start to see the opposite. People are reducing their hours. Full-time is only doing that sort of mandatory time, no overtime, and then casual workers and part-time workers reducing their hours.
Number 3, Blair says the data appears broadly in line with what the Reserve Bank of Australia would have been expecting to see.
Overall, we're still getting that slow grind up in the unemployment rate. We're starting to see employment growth slow down, and we're starting to see hours worked decline. If we look at our FTE POP, our full employment indicator, when we look at what's happened to hours worked versus population growth, it does show that the labour market has loosened a little over recent months after being just a bit tighter in the first little bit of the year.
Number 4, Taiwan's central bank left its key rate on hold at 2% yesterday, as expected. ANZ Chief Economist for Greater China, Raymond Yung, says the CBC did increase bank's reserve requirement ratio by 25 basis points and tightened certain loan-to-value ratios to cool the local property market.
Looking forward, we continue to see the CBC will continue to keep the policy rate at 2%. We don't expect any surprising hike again, as they did in March meetings. So because they have also saying or expect the inflation outlook will be cooling down in the second half of the year, growth will also be slowing down in the second half of the year.
Number 5, the Bank of Japan has a monetary policy decision later today. ANZ senior rate strategist Jack Chambers says ANZ is expecting a 15 to 25 basis point policy tightening, particularly after officials started jawboning the yen much more hawkishly in recent weeks.
If the US Fed doesn't need to ease all that aggressively, that has knock-on effects for Japan because, of course, Japan is a bit of an outlier. Last week, we saw the European Central Bank and the Bank of Canada easing. We're talking about when will other central banks ease, and for Japan, we're talking about when are they going to hike and when are they going to tighten. So ultimately, the longer other central banks hold policy rates at elevated levels, potentially the more it forces the Bank of Japan to almost catch up a little bit to them.
Jack Chambers there. Now, in our bonus deep dive interview, after yesterday's weaker-than-expected CPI numbers, ANZ senior China strategist Zhaopeng Xing explains to my colleague Alex Tarrant why Chinese authorities are expected to introduce additional stimulus later this year.
We don't think China economy can have a sustained recovery in the next few quarters because of the property woe. I think the property sector, both investment and sales, will drop very significantly in this year and the next year. So we don't expect it can make a turn around. Other sectors may offset, may mitigate the output gap a little bit, but not fully. We continue to expect the government to stimulate the economy by policy rate cut and the increase in fiscal spending. At this moment, the external demand reflected by the China export to other countries remain very strong. It can buy some time for the policymakers to make the decision.
Then are there worries that these pending tariffs from the Biden administration will affect that external demand later in the year?
Yeah, it's highly uncertain of the result from the U.S. election. Basically, I think China will have a bottom line. In any case, I think China will stick to the bottom line and continue to focus on domestic economy amid the external headwinds. So we expect the growth momentum of China will slow again in the second half of this year, and the outlook will be really highly uncertain in the next year. At this moment, we keep our GDP forecast for 2025 at 4.5 to reflect the headwind from the U.S. sanctions.
Is there any hope of hitting that official mark of 5% GDP growth, but also the official CPI mark of 3% annual CPI inflation?
I think for 3% CPI target, I think it's upper bound, not average level that China must to achieve. But for the GDP target, I think 5% is achievable. Basically, we see China growth potential maybe much higher than 5% because China has excess capacity at this moment. If China industrial capacity utilization reach 80% like that, China GDP growth, I think the GDP potential could be 8% or 10%. But at this moment, 5% I think is sufficiently for China to meet the challenge over capacity.
Zhaopeng Xing there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, June the 14th. Catch you next week as we look ahead to the RBA's rates decision on Tuesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.